I guess, Bill Gross, I look at this and I see the revisions down in a little soggy report. It's once again putting a good month back together with another good month and another good month after that. We can't seem to get there.
I think that's true, and I think August, historically has been different and been a little bit weak. But nonetheless, the wage revisions, I think, strike me the most, and the 0.1 in terms of the wage growth strikes me as well. Inflation, not job growth, dominates central bank thinking these days. And while I think low unemployment percentages historically have led to higher wages, and inflationary pressures and the fabled Phillips curve, which assumes this, I think it appears to be broken. And year-over-year core inflation, which is what the Fed looks at, is increasing only at 1.4%, and it's down from 2.1% only six months ago. And so I think the Fed is focused on wages and certainly inflation to the extent that wages are reflective in that. And this is a weak report.
Let's synthesize Mr. Gross's outlook there, folks, into what we see on the Bloomberg. I see a 2.11% 10-year. Bill, in the angst of Korea 5 days ago, we got down to 2.09%. Steve Major over at HSBC says we can go below 2%. Do you agree that there's a set of news or a set of economic data that will give Janet Yellen a 1.99% 10-year yield?
Well, geopolitical, perhaps. North Korea is certainly important, and money moves to quality and to safety when global events threaten. Global bonds have rallied 10 to 30 basis points over the past few months due to, in my opinion, not necessarily due to North Korea, but unprecedented liquidity from the ECB and the BOJ. They've written $1 trillion worth of free checks per month. It keeps investors happy and the economy's humming for now, but we see Japanese 10-year rates now are at 0% and bonds at 35 basis points, and that makes our 10-year attractive at 210. And perhaps it can go down to 2% because these other alternatives are extremely low and moving lower.